Chapter 3 is a collection of a whole bunch of different tools. Some are statistical, some are financial, and some are analytical. So I hope you'll enjoy this particular chapter. It includes many things we'll use in this course and I believe will be helpful throughout your career. So the comic on the right says, 73% of statistics are made up on the spot. I sometimes think about that because I hear reports that sound a little implausible. It's supposed to be like real data, but it sounds a little bit implausible, like this guy. Our first topic is basic statistical concepts. Again, you've probably seen them before, but it's good to do them one more time. Then we'll do some performance improvement tools, and this is just a selection of one slide per tool, just to familiarize yourself with some pretty powerful things that we see in industry. The third topic is overhead allocation. It's an important topic for all companies because we want to measure performance not just at the company level, but at the department and division level. And to do so, we need to allocate overhead. Fourth is we'll look at financial relationships between different aspects of the reports, and we'll see how these work as far as company versus department versus industry. Then we'll cover expected values and decision trees. You may have seen this before. If not, it's a powerful tool that we should have in our quiver. And finally, look at quantifying risk, ways for us to, when we finish the model, be able to show our bosses that we've been thorough in our consideration of what else may occur other than our expected case. Here's a refresher of basic statistical concepts. Quartile. That means you array all the data from top to bottom, and then you take a quarter at a time. Quartile is basically 25%. That's how you remember that. So we'll have 4 quartiles within a data set, but they're not in a random order. They're rank ordered from top to bottom. Then we have decile, which is very similar to quartile, but instead of quarter or 25%, it's 10%. So we have 10 deciles. The third topic is Pareto analysis. Similar to this, it's the famous 80-20 rule. So we array the data, and we see if we get to 80% with 20% of the data points. And this shows the accumulation or the consolidation of the major activity among a few of the items not evenly distributed. Fourth is the statistical measure of a mean. This is a straight average. It's an arithmetic average of the data points. Fifth is median. When we array the numbers in order, what is the midpoint right in the center of the entire distribution? And sixth is a standard deviation, where we make the assumption that our distribution will mirror the standard deviation. And if we allow ourselves that one assumption, then we can make some very powerful assumptions like how wide a range might we expect as far as capturing a number, the magic number for one standard deviation of 68%. So one standard deviation plus or minus from the mean will capture 68% of the observations. So these are very powerful and basic statistical measures. We're going to use an example just to see if you can still remember how to do this. Of course, I'll be doing it, you'll be watching, but I'm going to do it in Excel, and that should trigger, hopefully, fond memories about statistics. And we do them in a slightly different order because of the way the spreadsheet is set up, but we'll hop into Excel at this point. All right, here's the data in Excel, and it's just an example with an array of different product numbers. Then we have for those products the unit sales for each product, along with the year-end quantity in inventory. So we have sales during the year and then an endpoint at the end of the fiscal year. Then we have the unit cost, and the unit cost is how we record inventory. So the number of units times the unit cost equals the extended or the inventory carrying cost. And that's what we see here in the buff colored column. Then we have that as a percent, just as a calculation to save us a little bit of work. And next to that is a day sales and inventory. Gives us a feel for how fast these items turn in inventory. The smaller the number, the fewer the days, the faster the sale. The bigger the number, the slower the sales, and that's not good. And on the far right, the column is cost of goods sold, which is simply taking the number of units sold during the entire year times the unit cost at the end of the year. So it's an approximation of unit cost. It's an approximation because the cost for the inventory may vary from time to time. But this just gives us a feel for the amount of volume that we sold of particular products. So we see here that we have a fair number of data points, not a lot in real life terms, but enough for us to do some good work as far as some analysis. I'll go to the bottom now to do the measures. So first up is a median. Median, as I mentioned, is the easiest one of all, and it's simply the straight average. We could just put in equals average, So the average is 1,866. So that's the average value in the inventory. Next, we'll do a sort. For the sort, we'll just shade the region we want to cover. And I'll shade the entire region of the data along with the header row. And then go to Data, Sort, and select the field I'm interested in, which is Extended Cost, which is the inventory balance that I mentioned, that kind of buff colored column. And we'll do it from high to low and say OK. So it's a pretty simple function, and you can just visually see that it worked. And the largest item in inventory is this unit 1015 with $14 million worth. And now we could do a few things. First, let's do median. Median, as you recall, is the midpoint. So I'm just going to shade any of the rows. And it does a count. You can see it perhaps on the bottom there. It is 40 rows of data. You'll also see it here as a count. Also the average there. All right, so we could have done it that way. I just did it by Excel formula. So if we have 40, the midpoint is around 20. So let's find the 20th value. So that is the 20th value. Now when we have an even number like 40, the midpoint is actually not 20, it's not 21, it's in between 20 and 21. So to be precise, the median will be the average between these two rows right here. I'll just do it right here. So it's the 400 plus the 392, and you take that total and you simply divide by 2. So the median is 396. All right, next we'll calculate the standard deviation. STD, standard deviation. And here we have a sample. And we'll shade the region. Make sure we capture all the data points. Close friends and enter. And that number is 3,352,000. The interpretation is that there's a mean, and that mean is about $1 million. But the standard deviation that would capture 68% of the data points is plus or minus 3 million. So it's a pretty big range. And you can see why there's some very large values inside of our data set. Next, we'll do the Pareto. For that, we'll need cumulative numbers. So I'll put cumulative and then the percent of the cumulative. And we're just going to keep a running tally where we go from the biggest to the smallest and see how long it takes us to get to 80%. So the first figure is we'll have just that number because cumulative is just that one number anyway. But the second one gets a little more interesting. It's the prior plus the new data point, and we'll just continue that down. I can copy that now all the way down. So the next one we'll do is calculate the cumulative percentage of the total. The first number is 14, and we're going to divide that by the number on the very bottom, this number. But this needs to be an absolute reference because it won't change. That is the total. It will not move down as we go down. So you hit F4, which puts dollar signs in front of the column and the row designations, and you can see it right here, $E and $93. Notice that the numerator, I-52, we're leaving alone as a relative, so as we move down, it'll move. As we move down, it'll increment down to row 54, 55, etc. And yet the next factor, the denominator, will not move. So we'll do this. Oh, there's an interesting number right there. 20% of the entire inventory value is held in one product number. All right, we'll just continue this down. And we'll see that it keeps rising. So we see that we get to 80% right there. So I'll just kind of highlight this row. So we can say that 80% of the value is comprised of these items here. And when I just shade it, I can see that the total number of columns is 8. 8 out of 40. 20% of the inventory comprises or constitutes 80% of the value. So this, by construction, I'm supposed from the author of the book, is the 80-20 rule, where 20% of the items, again ranked ordered, the top 20% of the items comprise 80% of the value of the entire inventory. So that's the Pareto. Normally it won't be so neat and tidy at 80-20. We'll see that kind of accumulation or aggregation in the larger selling items, but won't magically be 80-20. There's no rule that it has to be 80-20. Next is quartile. Quartile, since we have 40, we just create breaks. Every time there's a quarter of 40 or 10, there's a break. So we'll just do this. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, so that, and this is the first quartile. We can sum the inventory in that first quartile, and that's $65 million. Then we count the next batch of 10. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, so there at row 72, well, that makes sense. Because the next quartile equals sum. So the next quartile is only $5 million. So again, we see that heavy concentration among the most popular items in our sales and our inventory. And the top quartile captures $65 million of value, which comprises 87% of the total value. The next quartile captures another 5.7 million, which is only an incremental 7.6. So we could do this for the other two quartiles. Obviously, we'd get to 100% of inventory. So that's quartile. And again, it's another way to view this heavy concentration inside the top few units. And deciles we're splitting by tens. Okay, so 10 would be 4 per, because 40 divided by 10 is 4. I won't bother doing that, but we would just count off 4, insert a row, do a total. Same routine. So that's some basic stats on mean, median, standard deviation, Pareto, quartile, decile. Next, we're going to look at some tools, and we'll go through one page at a time just to show you a picture of it if you haven't seen it. And if you have seen it, you'll remember these hopefully at first glance. This is a root cause analysis. It's also called the Ishikawa fishbone diagram, quite descriptive. It looks like a fishbone. And it says at this end, what is the problem? What is the issue we're trying to analyze? Here there was iron that was found inside the product, which is not a desired outcome. So then we have these 6 factors that may have caused the problem, and their measurement of the item itself, the iron, the materials that were used in the manufacturing, the methods that were used in the manufacturing and measurement of iron content, then the environment in which the manufacturing occurred, manpower that was involved in the maintenance and manufacturing of the product, and then the machines themselves. And we then break these into details, and we will then hopefully get to the bottom of it and see what's happening, right? So that's an example of a root cause, and it's just an organized way to be thorough in looking at all the possible things that are wrong and hypothesize as to what might be happening. And with that series of testing, we'll get to the bottom of the issue. The next topic is lean manufacturing. Sometimes we call this Japanese manufacturing techniques. It's a bit ironic because one of the people that was credited with bringing these techniques to Japan was an American, William Deming, and he brought this to Japan because he didn't have as willing an audience in the United States. It's a shame because we've been playing catch up ever since. So this is broadly characterized as lean manufacturing technique, and you can see it encompasses things like just in time. Just in time just means everything arrives just in time, raw materials, the subcomponents of manufacturing, so everything runs smoothly from the intake of raw materials all the way through the factory to the output, in this case, in Toyota's case, a car. And along the way, we have all types of things to ensure that we have good processes and good team dynamics in how we run the plant. So these are collectively called Japanese manufacturing techniques or lean manufacturing. The third is continuous improvement. Again, this has roots into Japanese techniques, and the word Kaizen captures the idea of small incremental improvements that collectively mean big changes. So this is a cycle of continuous improvement. These are actually words to live by. We want to epitomize continuous improvement in our own lives and in our businesses. So this goes through a cycle of getting everyone involved, looking at problems, encouraging people to brainstorm and come with solutions, testing it, make sure it works, adopt it, and then go do it all over again, right? Continuously, as the name implies. The fourth topic is TQM, Total Quality Management, and these are all highly related. And these are the 8 elements of TQM that move toward quality in everything we do inside of a company, with the idea that the end product to the customer is encompassing and has the characteristics of the quality we seek. There are certifications. In this case, it's Six Sigma. There are many certifications these days related to these advanced practices or preferred practices, and Six Sigma is one of them. Six Sigma relates to the standard deviation. It's not one standard deviation, which is 1 sigma. It's 6 sigmas. Way, way out there, so the probability of default is approaching 0. And that's what we mean by Six Sigma. It means we're approaching perfection in what we do. And sometimes you hear these terms like, I'm a black belt, right? A black belt is an accomplishment of a certain level of proficiency in the techniques. And here it's called a full-time project leader would be a black belt. The next technique is benchmarking. Benchmarking we've seen before, and it's where we compare something to another. And in this case, we're comparing ourselves to another company or an industry average. So step 1 is let's measure ourselves. Step 2 is find a peer group. Again, they may be aggregated so as not to be confidential in nature, aggregated numbers from an industry. Then we learn from that comparison. Are we stronger, weaker, and try to see why. And in that question of why, then leads to action that we can do to improve our performance. Our next topic is a necessary evil, and that's overhead allocation. We will not get into this much inside our course, but it is an important item inside companies. And why? Because we manage profitability not at the corporate level, but at the division or product level. And in order to do that, we have to capture the cost that is involved in a product or the cost that's involved in a division. That's why we need to do it. It's not just to keep accountants fully employed. Then the basics are, it sounds simple, right? Let's see, if I have rent, would I just take the rent in total and divide it by the square foot? And then based on that, if I occupy 10,000 square feet, it would just be 10,000 times that number. It seems like an easy thing. Well, that's an example of what works. It works when it's an objective measure that matches the economics of how much resources is taken up by that particular department. When it doesn't work are examples when it's not in the control of the manager. For example, if there's a corporate jet that the CEO flies around the world in, and the manager in a division somewhere in the middle of the country gets charged for a part of the corporate jet, he or she won't be very happy because they didn't get to ride that jet. So when it seems like it's just appearing out of thin air, no pun intended, and it just hits the profitability of a department or a manager, that doesn't feel right. The other side is where it becomes arbitrary. It just says, okay, I get it, I use this particular item, but the method by which you allocate it doesn't seem right. So, for example, on that rent, if you just took the number of products in a building and you say, oh, I'm just going to divide the rent by total products, and you say, wait a minute, I have this tiny little product. Why is this product being charged so much rent? There's a product down there that has a lot of volume. You should charge them more rent. And that is an example where it seems a little arbitrary or not really capturing the economics. So I'll give you some examples with numbers, and that will illustrate the point. So the first is, let's look at the wrong way, then let's look at the right way. And we'll do this in Excel. What we see here on the left side is an example of a company with 8 products and also some parts sales. And they have dollar sales here, $51 million, and the percent, simple math there, just showing each product and their respective percentages. Then on the top here, we have the total cost of 2 departments, order processing and customer service. And it's 1.2 million and 750. We say, well, that's 1.95. Let's just divide it based on sales. So I said, okay, 3% of 1.2 million. And again, I need a reference where that does not move, F4. And I can copy that. So this allocates the total amount of 1.2 million across the products based on their percentage of the total sales. Pretty easy math. Next one is customer service, same thing. That percent times the 750 lock it with an F4, and copy it. And we've allocated $750. So now we have the total overhead charged to product line 1 of 34 plus 21, which is 56. So the net is the sales minus the cost so far anyway. And we can copy that. That represents the amount of money net of these two overhead departments of how much we got. And no surprise, the margin or the percentage that remains is the same, 96%. Now, what's wrong with this? I bashed it. Like, why is it wrong? Well, what if product line number 1 absorbs a lot of resources way beyond the 3% of sales that it comprises? Then they just got a deal. They got charged 3% of the cost when they absorb all of the customer service and the ordering resources in the company just to handle this fairly small part of the business. Well, then it doesn't seem right because they've been subsidized by the items. Let's say on the other side, we have a big product line number 6, and they're saying, whoa, wait a minute. The reason I'm big is I have very few, very large orders from very few customers. And because of that, I don't take nearly as much of the resources that comprise my percent. I have 25% of sales are my product, but I don't have 25% of the orders. I don't have 25% of the customer service. So this shows the weakness is that, yeah, it's easy and it's objective based on percent of sales, but it doesn't mean it's right. And that goes back to this point is that does it work? Well, it doesn't work because the allocation does not seem to mirror the economics of what's going on here. So is there a better way? So a complicated but powerful concept is called activity-based costing, ABC. And the concept is easy. It's over here before you look at the complicated thing on the right. Your product should be charged based on how much it uses from the overhead departments. So if it uses a lot, it should get charged a lot. If it doesn't use a lot, it should not get charged a lot. That's the logic of it. It's pretty hard to argue with that. Now, if we're doing this in companies, then it gets complicated. Why does it get so complicated? It seemed like such a simple idea. Well, the reason is that there are quite a few different costs that are broken into a lot of different units, cost centers or product groupings. So we have these resources, and we have n number of resources. And then each of those resources do specific things for multiple products. So now I'm an engineering department. I serve the manufacturing lines, but I help every manufacturing line for every product we make. So now we have to say, okay, how much did you spend? So you pool the cost in your activity pool for your engineers, and let's say it's $10 million a year. Then you say, well, how do I charge my $10 million to all the products that roll through this factory? And it might be based on the assignments that you give to your engineers to go support the manufacturing process. So there's bookkeeping involved in saying, okay, let's then allocate the timesheets of the engineers and say, how much time did you spend on the lines to support products and delineate which products you supported with how much time. A lot of work. So you can see if you do this for every single overhead department that supports the manufacturing of a complicated company, you get this thing that looks like spaghetti on the right side. In this example, thank God, we have a simple, much simpler scenario, right? So we'll go back to Excel. So now we have still the same sales. We have still the same amount of costs, but instead we're going to base it on the drivers. So again, we have a cost pool. In this case, order processing is a pool. And then we have the total cost, which was $1.2 million. You take $1.2 million divided by the total number of invoices processed, and you get a cost per invoice process of $152. Customer service, let's say that they handle returns. So you say, okay, the $750,000 is servicing about 1,000 returns during the year. So that means every return costs us $736 to process. Now we say, okay, how many invoices were issued for product line number 1? Here it's 862. So the charge should be number of invoices times the cost per invoice. And again, let's lock that with F4 and copy it. And then we allocated the full 1.2 million as we did before. But we didn't do it on a percent of sales. We did it based on which ones are tedious with lots of invoices and which ones are easier where we have fewer invoices with bigger amounts. This would capture that difference. Then we say, okay, returns. Which products have large or small numbers of returns? So 20 returns for the first product. Each return costs us $700 to process. F4 to lock. Copy it. And that equals a 750. So in total, we know we're in good shape. Total allocated is the sum, $1,950,000. Now we can do the same thing as net, is take the sales minus the cost equals net. And here is the result of what we just did based on ABC. And we see there's not all at 96% now. Why? Because let's take an example. This one's a pretty bad example. This is a line item, the parts, where there seems to be a lot of work involved, a lot of invoices, a lot of returns. So it absorbs a disproportionate amount of costs for such a small line item. It's only $1.6 million in total revenue. So this particular margin is slammed because it's really high cost. Now let's look at the other end of the spectrum. Who did we charge too much to? And what we see here is 99.6. So in other words, that product line, oh, it's the one we just talked about, product line number 6. We had charged at 24% of all the costs. It turns out it's a very light touch. Not that many invoices and not that many returns relative to the massive size of the volume of sales. So we should have been charging it a very small amount, which comprises less than a percent. So we way overcharged this product for the overhead. I think with this example, you see that although it's more complicated to do an ABC style of allocation, it's much more precise and more fair or more objective in charging to the product lines the amount of money that should be charged because they use those resources. If you use the resources, pay. If you don't use the resources, don't pay. And we saw examples of that where the parts need to pay, so we charge them more. Whereas product line number 6 doesn't use that much, so we don't charge them as much. So this is kind of in the spirit and a good illustration of the value of using ABC. Next, we'll look at business models, and this is just showing the relationships between the financial elements of the income statement and the balance sheet, and that we can use that as different levels. There are Excel sheets for each of these. I'll just show you here because it's quite easily visible. And this is just saying for our same model company, Roberts Manufacturing, what are your revenues? How do those comprise as percent of revenues in terms of the cost of sales, the R&D, the SG&A, and that gives us some diagnostics on how profitable we are and where we spend our costs. Then the next section below deals with asset utilization. So how well are we managing our balance sheet? So the first couple deal with our working capital, the inventory and receivables. Are we turning over fast? And if you recall from our prior class, they're not very fast. Here it takes them 73 days to collect their sales. That's slow. It should be 30, right, in general. Next, inventories, 146 days. That's also very slow. That takes them many months to sell their inventory. So we're seeing elements here which are quite illuminating, not in a good way, that we're highlighting some potential problems. That bears some further investigation. The other elements of turnover are other elements of the capital and the assets. Fixed assets, total operating capital, and also total assets. So we're just seeing how well we utilize assets to generate sales. The next category is leverage. How much debt do we use compared to equity? And here, the debt to total capital is 15%. That's not that large use of debt. And the bottom shows some measures of return. The first is return on equity at 17.6, and it's simply net income divided by equity. The last item here is return on invested capital. The invested capital comprises not only equity, but also debt. Debt in the form of a loan from a bank and debt in the form of a bond. So invested capital equals loans plus bonds plus equity. So since that denominator got bigger, it's going to bring down the return number from the ROE number of 17 to the ROIC number of 15. And it goes down because we have some debt. The next is we could use the same approach where we have these metrics, put them in an orderly fashion. And here we're looking at 6 different companies, from Accenture to IBM to Apple to Southwest Air. So very different industries with different economics entirely. This actually highlights the difference in the businesses and their economics. We see a company like Apple with high revenue growth, 8%. And we also see they have good margins at 39%. Then we have another company like, what's a good example? Southwest Airlines. It's a well-run airline, but their EBITDA margin is 4%, way less than Apple. This particular type of analysis uses the same kinds of things that we did when we look at Roberts Manufacturing, but now we're doing it across different companies in an industry, or in this case, across different industries. Next, we use the same type of lens to evaluate inside of our company, but at a product line or a division level. Here we break our company into different groupings of equipment versus components, high growth versus mature parts of our product portfolio. And again, we use the same metrics. If you look at the rows here, there's still R&D, their gross margins, net margin, DSO, DSIs. So we use the same metrics across different scenarios, and they all give us some insights. The next topic, topic 5, are expected values and decision trees. We use this quite often when we have some level of uncertainty. When they say, well, what do you think the revenues will be? Well, I think it'll be $1 million. Well, could it be higher? Yeah, it could be higher. Could it be lower? Yeah, it could be lower. So all of a sudden, say, well, then you're not really sure in your revenue estimates, are you? So we say, how do we get some more ways to evaluate just how certain we are? So these are 2 techniques. I'll show both in Excel. The first is expected value, and the second is decision trees. All right, so here's an example of expected values. Simply saying, well, what do you think we'll do? Well, I think we'll sell 1,000. Oh, really? How certain are you? Could it be higher? And they say, oh yeah, it could be 2,000. Could it be lower? Yeah, I guess it could be 200. All right, so now we've bounded the range of possibilities. The next pass through is say, okay, help me think, like, how likely is it that we will hit the number you said, which is 1,000? Oh, I give it about a 50% chance. Bingo, write it down. You say, well, that best case where you thought it could be 2,000, out of 100%, what chance might that be? Well, it's actually pretty high. We have a great product. I think we're early in this market. I think we'll do some damage. I think it's 30%. Oh, good. Well, how about this worst case where it's not going to go so well? The remaining amount is 20%. Does that sound about right? Oh, yeah, that sounds about right. So all of a sudden, we created something quantitative from impressions. And this is not the most commonly used thing, but it's not bad, because you'll find that people that really know their business have an innate feel for many aspects of the business, which often rival computers. It's not as rigorous, of course, as fact-based, but it's not bad. So now let's use the technique of expected values. So I'll just put EV here. The expected case is 50% probability that we'll get 1,000. The best case is 30% probability that we'll get 2,000. And the worst case is 20% probability that we'll get 200. When we add those together, we get a number of 1140. So that is the expected value. So when we took a shot at it, oh, I think it'd be 1,000. Well, with a little bit more rigor, kind of thinking through what might happen on the high side, what might happen on the low side, and factoring those in with our estimated probabilities, we say, we're pretty close to 1,000, but now I think I'm a little bit smarter. I think it's 1140. Anyway, that's how we refine it using expected values. The next approach is to go one step further and build a decision tree where we kind of map out what happens in between the launching of a product and the actual getting of results, right? Instead of just looking at it in the future and saying it's 1,000 or 1140. Now we say on the right side, we say, well, let's start our rollout. What might happen? It could be great, it could be okay, or it could be bad. What's the probability of those happening? Well, it's about 40%, 35, and 25. Okay, fine. If it goes great and now you got the test market results and now you launch, what's the likely outcomes there? Well, it could go well, and it's pretty certain because the test went well, our planning was fantastic. So there's about a 7% chance of this group that it'll be really good. Yeah, we never know, so 30% won't be so good. And we do the same for the just okay branch and the bad branch. And we get these endpoints. And when these endpoints are great test, high launch, great test, low launch. So each of these numbers here comprise a certain scenario. And so when we do this, the way to get this number correct is we say, well, what's the readout? 2000. And the probability is we just trace the tree. So you start here at 40% and you multiply it times the next one of 70%. And if you had 10 different nodes of this, you would just multiply it times 10 different percentages. But here we don't have 10, just for illustration, we have 2. And so we'll do that for each of them. And one test is the probability better equal 100. It does here, which means that it worked out fine. It means we explained everything. Now we get to the last and most important part. You take these percentages, just like we did on the EV, to get what happens. So we copy this. And we get 1155. And we've just refined our estimate once again. If we just took a shot at it, I think it's 1,000. If we do an expected value based on some just broad guesses of best case, worst case, etc., we get 1140. And we say, well, let's just kind of map this out. Let's walk me through the steps by which we will succeed in selling this product, from test marketing to launch. And we do that, and we assign probabilities, and we're at 1155, right? These are all close. It will probably not be this close in real life, but the processes we're looking at. One is you can say, here's my base case. That's level 1. Second is, well, let's do a little bit more around expected values to get a second case. The third is, well, let's kind of walk through the steps and assign probabilities using the steps and the outcomes, and you get further refined. So this is just a progression of getting better and better results inside your model. The next and last set of things we're going to talk about is when we quantify risk. So let's say we have a number and we want to test it out. There are 3 methods. We're going to do 2 now. We'll do another one next week. And the 2 we'll do now are sensitivity analysis and scenario. And it's like what you've seen before. I'm pretty sure you've seen these 2 techniques. So sensitivity is, well, let's work it out. What's the base case? Well, we have 1,000 units at $25, so the value of our sales is $25,000. The cost is 4%, so the 4% cost is 4% of what? Of that, and our profit is therefore revenue minus cost. All right, so that's our base case. And we say, well, let's see how sensitive things are. What if our unit sales is off and it goes more by 25%? So that is equal to the sales times, open parens, 1 plus 20%. So our sales are 1,200, right? You probably knew that just by looking at the number. And then let's just play it out. Oh, okay, the sales price is the same, and the revenues are the same calculation, but now because we sell more, we make more. The cost is still 4%, and our result there is we sold more, so we pay more, and our profit is higher because we have a very profitable business here. That's if good things happen. If our unit sales are off in a good way by 20%. What if we're off in a bad way? It goes less by 20%. So now we take the unit sales would be 1,000 times 0.8 because we lost 20%. The sales price is the same. Our revenues will have the same relationship. And then we're still at 4% cost. And 4% of revenues is that. And therefore our profit is lower because we sold less items. So it drops to 19,000. What if we had costs go up by 10%? So now these stay the same. And this changes. So this is 4% times 1.1. And the cost then would be 4.4% times revenue, and our profit would then be 23.9, almost nothing. Now, what if it goes down by 10%, right? So these stay the same. We have this number times 0.9 because it goes down. So the cost will go down and our profit up, right? So what we've done is to do some sensitivities around two variables. The first variable are sales, plus or minus 20, and the second one are costs, plus or minus 10. And we see how sensitive our profit is to these changes in assumptions. What do we see is that we're pretty sensitive to this variable of unit costs. Look at how much it jumps and drops. But we're not as sensitive to the cost changing. It makes some change, but not much, right? And the reason, just logically, that you could have done this without doing all the math. And the reason is that the cost is so low anyway. It's only at 4%. So if it grows, it can go quite a bit higher without really hurting us. Whereas the unit sales, that's where everything starts. You start tinkering with that number, all kinds of movement occurs, right? So the results are not particularly shocking to any of us, but it's in line to illustrate what we're doing in sensitivity analysis. All right, next on the right side, we'll do scenarios. Now scenarios aren't like doing one variable at a time, tweaking it, which is what we did in sensitivity. Now we're saying a scenario, like scenario I wrote here, everything goes viral. So if it goes viral, the unit sales are going to go nuts. It's going to go to 2,500. And our price will still be the same because we didn't change price. So our revenues will jump because of our massive viral effect in our business. And our cost is still 4%, which means our total cost will be 2,500 and our profit. And they would say, well, what if you get bad reviews? Uh-oh, we won't sell 1,000. We're going to go down to 700. And then the 25 will still hold, and the sales amount will then drop pretty dramatically. Our cost is the same, so the cost will be that. And whoa, we go from 24,000 down to 16. That's not a good thing. Competition enters, and what happens is we're going to take a little bit of a hit on our unit sales, but not only that, they're pressing on our costs, and they're driving up our costs because they're grabbing our low-cost product. So now instead of 0.04, it's 0.05. What happens then? Well, revenue will go to 22,500. So we're down from where we hoped. But also, we took a double hit because our expenses went up as well. So now we drop all the way to 21,375. So the difference between sensitivity analysis, where you take one variable and tweak it a little bit at a time to test just that factor, a scenario could have multiple things changing, illustrated most by the last item here, which is in the scenario of competition entering, we both take a hit in our unit sales and our cost structure goes up because they're starting to compete with us to buy raw material. So this is the difference between a scenario and a sensitivity. Summarizing this chapter then, we saw some basic statistical concepts, mostly review, I'm sure, for you. Mean, median, standard deviations, Pareto, quartile, decile. If I rattle those words off and you say, ding, 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 I've got it, we've done well. Second is, we looked at a whole suite of different performance tools that are used by corporations to better their operations for quality and for cost performance. Root cause analysis, the Ishikawa, lean manufacturing techniques like Japanese manufacturing techniques, continuous improvement like Kaizen, total quality management, Six Sigma, which is a certification for that. And finally, the wide set of tools in benchmarking us against some other static measure to see how we're doing and find improvement opportunities. In overhead, we saw the use of ABC, activity-based costing, and how that would add to the precision of allocations. Then we saw financial relationships that show profitability, productivity, profitability per unit of capital, and these could be used for your own company as a whole, or a company against other companies in the industry, or across different industries, or within a company for its products. So these ideas of gross margin or operating income or asset utilization, these are concepts that go across all of these, from companies to products to competitors. Then we looked at some refinements using the probabilities of things happening. We looked at expected value, which is a pretty straightforward application of using probabilities. Then we took one slightly more advanced, which is to build out decision trees with different nodes for things that happen along the way. And then branching, that's why it's called a tree. And that can lead to some more precise probabilities and outcome measurements to lead to more precision on the number. And finally, we looked at, well, what if we have a base case and we just want to test it out a little bit? What can we do? We looked at two methods. One is sensitivity, where we take one variable at a time and tweak it up or down. Or we do scenarios, where we tell a story. The one that we did was a competition enters, which makes it harder to sell the units you intended. And furthermore, they drive up the cost of raw materials because they're competing with you to buy raw materials. Therefore, your costs go up. Right? That's a scenario where you can and are expected to change more than one variable because the scenario is more complex than simply tweaking one variable at a time. All right, so thanks. I will see you in class.